Bloomberg Audio Studios. Podcasts, radio, news.
Carlyle announcing today that it has raised $5.7 billion for its latest flagship credit fund with more than $7 billion with leverage. It's the fund's largest ever credit pool, exceeding the roughly $4.6 billion raised for the prior vintage in 2022 for opportunistic credit. For more on this, we are joined by Mark Jenkins. He is head of global credit at Carlyle Investment Management. And we have to put this into context because you're looking at opportunistic credit. You have $200 billion in credit here.
Yeah.
So why is this pool of capital so interesting at this point in time? It looks like you're looking at very specific, nimble ways to get into the market.
Yeah, thanks, Sonali, for having me on. For us, this is like, a very important step forward as we continue to develop the broad platform that we have. Opportunistic credit is one of our core strategies on a very diverse platform for us. So we focus on how we can have a diversity of products so we can attack, if you will, or look for opportunities across the market as we go through opportunities. Opportunistic credit for us is really working with family, employee-owned type businesses that we structure bespoke transactions for, and they're typically underbanked organizations that look for capital solutions up and down the capital structure. So I think we have a unique perspective in that regard. And have been building that, that reputation in the market over the past 7 years.
It's interesting because you've seen over the last couple of years, ever since you saw the Silicon Valley Bank kind of step back, and then you saw the interest rate movements really shut out a lot of banks from the market. Is this opportunistic opportunity bigger now that you're seeing the banking system step back a little bit?
Yeah, I think it's kind of twofold. One is when we look at these companies, they generally, the opportunistic strategy for us is going to where there's fewer participants looking to bank these people. So part of the pullback in the banking system, is not serving these companies well, if you will. We also have a very large team in Europe as well, and there's great dispersion, if you will, and fragmentation in that market. So it does create a lot of opportunity for us there in terms of how the banks have pulled back. But overall, it really is bringing the full scale of the platform to bear for capital solutions. And I think that's the key thing for us in terms of the strategy.
What's the return profile? What can you expect back on a strategy like this, and how does it compare to other type of credits?
Yeah, because of the complexity, because of the bespoke nature of it, you're actually charging a premium above what somebody would get in the capital markets. And because this is also typically not something that goes into the direct lending market, you're looking for returns that are 300 to 400 basis points above sort of first lien direct lending, if you will.
It feels like Carlyle and many of your peers are looking at direct lending and saying this is, yes, a large opportunity, but maybe there are larger ones elsewhere. You've been diving into asset-backed finance, now more opportunistic credit as well. What does this mean about the biggest growth areas for your credit business moving forward?
Yeah, for us, we've been kind of consciously building out this platform, which really spans everything from public or liquid corporate credit, private credit, real asset and asset backed, so that broad spectrum, if you will. And right now our power alleys, if you will, are really on the CLO side, the opportunistic side and asset backed side, and I think that's where we see the growth. But it depends on where you are in the cycle. So in 2023, for instance, the CLO market was closed effectively. We didn't do anything. This year, we've had a record year. We've priced over 36 CLOs, refinancings, new issues, et cetera, and we've raised over $900 million of third-party equity. So quite a change. So you have to have that diversity on your platform to take advantage of the market opportunities as you go through cycles.
Power alleys, a strong word.
Yeah.
How are these things serving as power alleys? Is there something about these markets growing faster now than they were before?
Yeah, I think, you've got, specifically on the asset-backed side, you do have this secular shift where we've seen assets that weren't ordinarily available to us for private investment are now coming into the marketplace because of the shift you're seeing from basically banks in the United States in particular. Has to do with regulatory changes, how they manage their RWAs. It has to do with some accounting changes. And that's been a secular shift that we've seen over the past 3 years. But it really has come to fruition in the past year where we're seeing more opportunities versus capital formation. So we see that as a great opportunity for our investors and certainly an area where we're going to lean into and grow over the next several years.
As money flows into private markets, where's the risk? We had this great story on the terminal today about the record CLO issuance raising concerns because of the PIK provisions that are rising as well. If you kind of look around the world here that you operate in, where's is your biggest concern?
Yeah, I don't think it's so much the flows of capital into the private markets, because ultimately, when you think about who the actual investors are, they're much better matched to the private nature of it, i.e., when it sat on bank balance sheets, you're financing those with customer deposits, you're financing them in the capital markets, and that's not necessarily matching, asset liability matching. When you go into the private markets, you're looking for much more longer investment horizons, so you can ride the volatility that you might see in a credit. So the real risk isn't so much in capital coming in. Obviously, as capital comes into certain pockets, some places get very expensive, if you will, and that's always been through different cycles. I think the bigger issue is, how we deal with the economic environment going forward, as opposed necessarily anything that's going to happen in the private capital markets in particular.
There's this notion out there that public and private markets are converging, where some private capital providers have said, no way. Private is private, public is public. Yeah. How do you feel about that?
Yeah, I think credit is credit, right? I think equity is equity. So when somebody's putting it into their policy portfolio, nobody's saying, should this be private or should this be public? They're thinking about what is that exposure that I have in my portfolio. And I think the convergence that occurred coming out of 2023 is you've seen both private and public markets, and credit in particular, coexist in a very, I think, fruitful manner for the community, if you will, and that's creating better opportunities. So when I look at Carlyle in particular and look at the two buyout deals that we recently financed this year, they're very large buyouts. One's a carve-out, but we use the private markets to finance them. But at some point in the future, no doubt, we'll look to finance in the public markets. So they coexist as opposed to compete, I would say, and at various times they rub up against each other for that competition or that tension, but they're going to coexist going forward. Last
question from you. You were talking here about the macroeconomic environment. What happens next year? You look at a rate environment where there is still a substantial amount of rate cuts priced into next year's market, but investors also worried about even the possibility of a hike if certain policies come into play like tariffs. Are you worried about the dispersion here?
Yeah, I think our view is that we're going to have higher rates for longer. We've had that view for some time now. I think the macroeconomic geopolitical tension that you see, and the new administration coming in is going to be very pro-business, which I think is a good thing, is going to keep rates at a relatively high level relative to what the markets predicted, if you will. And what does that mean? I think what it means is it's good for the liquidity in the marketplace, but right now, if you take a look at financing costs for buyouts right now, and you look at the high yield and leveraged loan market, we're only about 50 basis points higher than when the Fed started raising rates in March 2022. So you've got a very good environment right now for financing, for buyouts, et cetera. There seems to be good momentum in terms of the economy. So as you look forward into 2025, we obviously are going to see some volatility, but I think we're in a very safe environment for investing.
Mark, we thank you so much for joining us here on set. That is Mark Jenkins, head of global credit at Carlyle, on the heels of a record-breaking fundraiser.